Hey everybody, so I wanted to show you a little bit about how day-to-day an accountant might record or process transactions. So in the past, we've learned about T accounts, and we use T accounts to find the balances of a given account. But day-to-day, what we do is we record something called a journal entry, or sometimes people will say we journalize our transactions. And so it's helpful to follow some steps when we journalize transactions. So these are the steps I still go through when I do it today, even though I've been doing it for 20 years. I just go through them really fast because I've done it a lot. And so for you, it'll be a little slower, and then you'll get better and better at it as you practice it more. So the first step is I identify the transaction and any source documents. Source documents could be things like receipts or invoices, anything where I get the information. In step two, I analyze the transaction using the accounting equation. Step three, I record the transaction in a journal entry form and apply the double entry accounting rules, debits and credits. And then finally, we post an entry. We use T accounts in accounting, and sometimes they use a ledger, which is just like a T account, but it looks a little different, and it's a little more, sometimes has a little more information. Anyway, so that's the process that we use when we record things in accounting. So I'm just going to step you through a number of examples, much like I did in chapter 1 when we stepped through how these transactions would impact the accounting equation. Now we're going to go through how the same transactions would be recorded. So here's our first transaction. We receive $30,000 cash from Chaz Taylor as an owner contribution. So that's sort of identifying what's happening. And then the second thing I do is ask myself, well, what is happening? Well, the company's receiving cash. So my cash will be going up, and it's receiving cash from the owner. So that's going to be recorded as a capital investment by the owner. So then third, I kind of ask myself, okay, well, what are the debit and credit rules going on here? So cash is increasing, and cash is an asset. So that will be increased with a debit. And then the capital investment is an equity account, and it's also increasing. So equity accounts increase with a credit. So right here where number 3, record is, this is an example of a journal entry where I'm debiting and crediting, and I record it all on one in one little entry like this. Always the debit gets listed first, and then the credit gets listed second, and you'll see that the credit is pretty much always indented like this. You'll just see that as kind of a standard for how journal entries are set up. So this journal entry is a debit or increase to cash, and a credit or increase to equity. And then 4, we post it to our T accounts. This is where we're going to keep track of the balances of those accounts. And posting is easy because we are already listed here as a debit. So we just put a debit over on the T account and put this as a credit, and put a credit over here on the capital investment. So there's our first transaction. All right, so let's take a look at another transaction. So here we purchase supplies for cash. So again, identify what's happening. We're buying supplies for cash, and then I identify, well, what accounts are involved in that. So the supplies account and the cash account, and what's happening with them. Well, supplies account is an asset and it's increasing, and the cash account is an asset and it's decreasing. So then I'm ready to record my journal entry. An increase to an asset account will be a debit. So I'll debit supplies, $2,500. And a decrease to an asset account will be a credit. So I'll credit cash, $2,500. Finally, I'll post those debits and credits over to the T accounts in the ledger so that we can keep track of the balance. So you can see on supplies, this is our first posting to that account. So we'll have a debit to supplies of $2,500. And then on cash, it's our second because we already did the $30,000 increase on transaction number 1. And now you'll also see that we have a $2,500 credit or decrease to the balance of cash. So let's take a look at another transaction. We purchase equipment for cash. So again, I would say cash, the asset, is decreasing, and equipment, the asset, is increasing. So then I'm ready to apply those rules and say, well, assets increase with a debit and decrease with a credit. So then I record it by debiting equipment or showing an increase to the equipment account of $26,000 and crediting cash or showing a decrease to the cash account of $26,000. And then I can post those, the debit and the credit, over to their appropriate T accounts. Transaction 4, we purchase supplies on credit. Remember, on credit means we're not paying cash to our supplier. Instead, we're promising to pay them later. So what's happening is our asset supplies is increasing, and our liability, accounts payable, money we owe the supplier, is also increasing. We owe them more than we did before. So then I try to go through the rules and say, when an asset increases, that'll be a debit. And when a liability increases, that will be a credit. So I will debit supplies, $7,100, and credit accounts payable, $7,100. And then I can post those amounts, the debit to supplies and the credit to accounts payable, to their appropriate T accounts. All right, we provide services for cash. So our cash is going up and our revenue is going up. So cash is an asset, increases with a debit, and revenue is an equity account, so it increases with a credit. So I'll go ahead and debit cash $4,200. I'll credit consulting revenue $4,200, and then post those amounts over the debit and the credit to our T account. A payment of an expense in cash. We're going to have cash going down because we're paying it out, and an expense going up. Now remember, expense is one of those special equity accounts that reduces our equity. And so its rules are going to be, I guess, the reverse or the opposite of other equity accounts. And so, when rent increases, we are going to debit that account. So we're going to debit rent expense. And then our cash is decreasing, and cash is an asset. So we're going to credit cash. Sometimes for me, it's helpful to not even think of revenues and expenses as equity accounts, but rather kind of their own type of account that will affect equity. For some reason, that helps me in my brain to just say, expenses are going to reduce equity. And so they're going to behave in an opposite way in which equity accounts do. But you may have to talk yourself through it in a way that works for you. So once I've debited rent expense $1,000 and credited cash, I can then post those over to my T accounts ledgers. All right, another payment of expense in cash, salaries expense. So same thing, we debit expenses and we credit our cash. Remember, that's how we show the asset cash going down. And then we can post those over to the T accounts. All right, our 8th transaction is we provide consulting revenues on credit, meaning we're doing the work for someone, but they're not paying us yet. And so we're going to, there's both consulting revenue and rental revenue, sorry. So again, I have an asset increasing, but it's not cash. Instead, it's accounts receivable or money owed to us. And then our revenue accounts are on the credit side because we're increasing our equity through those revenues. And so we will debit accounts receivable, $1,900, an increase to the asset, and then credit consulting revenue, $1,600, and rental revenue, $300, an increase to those revenue accounts. And then we post them to the ledger. We receive cash on account. So this is money that was owed to us, gets paid to us by the client. So our cash is going up and our accounts receivable is going down. Those are both asset accounts. So cash will increase with the debit, and accounts receivable, also an asset, will decrease with a credit. And then once we've recorded those debits and credits of $1,900 for cash and accounts receivable, we can post them to the ledger. Here we have a partial payment on our accounts payable. So we owe money and we're paying it. So when we pay it, our cash asset goes down and our accounts payable liability is also going down because we're paying off the debt. So a liability decreases with a debit, and then an asset decreases with a credit. So we will debit accounts payable $900 and credit cash 900. And then we can post those to our T accounts. And that just helps us keep track of the balance. Finally, our 11th transaction, the owner takes $200 out of the business. And so that's going to be a reduction to our cash. So a decrease to our cash of $200 and a decrease to our equity in the form of an owner withdrawal. And so whenever we would say that this is where it's confusing. We would say that that owner withdrawal is increasing, meaning before we had $0 in owner withdrawals, and now we have $200 in owner withdrawals. And owner withdrawals increase with a debit, just like expenses do. And then cash is an asset, and it will decrease with a credit. So we'll debit owner withdrawals and credit cash. And then we can post those to our T accounts. Once we've done that, oh, we have another one. Sorry, I thought that was our last one. Here's a receipt of cash for future services. So we're receiving $3,000 for services we haven't yet provided. So our cash is going up, but because we haven't provided the services, we're going to record that as a liability called unearned revenue, meaning we have to earn it at some point in the future. So our cash is debited because it's an asset increasing on the debit side, and our unearned consulting revenue, which is a liability, is also increasing, and so that's a credit of $3,000. And here's a similar idea. We're going to pay cash for a future insurance coverage. So since we're paying cash, cash is going down, and our prepaid insurance asset, because we have the value, okay, we own this asset of insurance coverage for the next 24 months, is increasing. So since they're both assets, we know that the prepaid insurance will increase with a debit. So we'll debit prepaid insurance, and then we'll credit cash because the cash is going down and assets decrease with a credit, and then we'll post them to our T accounts. Here's where we're going to purchase supplies for cash. So again, our cash will go down and our supplies will go up. So we'll debit supplies, an asset that is increasing, $120, and credit cash, an asset that is decreasing for $120, and we'll post those to our T accounts. Man, they got a lot of transactions in here for us. Here we'll pay another expense for cash, $305 for utility expense. So again, our cash is going down, utility expense is going up, expenses increase with the debit, and assets decrease with the credit. You'll see, if you think about it, a lot of business transactions are paying expenses. And so you'll see a lot of these transactions in real life, a debit to an expense and a credit to cash. That happens over and over and over in most regular business. Here's another expense we're paying in cash, paying salaries. So we debit the salaries expense to show the increase to the salary expense equity account, and we will credit cash, a decrease to cash. All right, so here's a summary of all of these transactions in a ledger, and you'll see that we have a balance in each account. And remember, we find that balance by adding up both the debit sides and the credit sides, and then subtracting the smaller side from the larger side and writing the balance in on the side that was larger. So cash, we would say, has a debit balance of $4,275. That's also like saying we have $4,275 in cash. Okay. Accounts receivable has no balance. You'll see the zero is put on the normal balance side, or the side that would normally increase the asset account, which is the debit side. Supplies, $97.20 debit balance. Prepaid insurance, $2,400 debit balance. Equipment, $26,000 debit balance. Our liabilities, we would expect them to have balances on the credit side, because that's the normal side for a liability. So you can see we have accounts payable has a $6,200 credit balance, and our unearned consulting revenue has a $3,000 credit balance. And then finally, our equity accounts. So those accounts that increase our equity, so the capital account and the revenue accounts, we would expect those to have balances on the credit side, because that's the normal side, or the side that increases those. And there you can see the C. Taylor Capital has a credit balance of $30,000, And the consulting revenue has a credit balance of 5,800, and the rental revenue has a credit balance of 300. And then those accounts that decrease our equity, so the owner withdrawals and expenses, we would expect those to have a normal balance on the debit side, because that's the side that increases those accounts. And in fact, we see that. So the owner withdrawal, C. Taylor withdrawals, has a debit balance of 200. Salaries expense has a debit balance of 1,400. Rent expense has a debit balance of 1,000. And utilities expense has a debit balance of 305. So I hope that was valuable, going through all those transactions and seeing how the debits and credits sort of work, and then how they're recorded in the ledger. So then at the end, we can find the balance in all of our ledger accounts.